Good morning, students. Welcome to accountancy class once again. In our previous videos, we discussed and studied in detail the changes in ratios. There we discussed about old ratio, new ratio, and about sacrifice ratio at the time of admission of a partner, right? Today in this video we are going to see the accounting treatment of different funds or reserves which we may find in a comprehensive question, especially in the balance sheet. We will find most of these items in the balance sheet. In some cases there will be some adjustments also. Now let us pick up these items once again without wasting much time. Here for your reference, I have mentioned here the old ratio of two partners. We have taken examples of two existing partners, or rather the old partners A, B with their old ratio 2:1, and C is the new partner, right? So no need to calculate any new ratio or what to say sacrifice ratio, because the sacrifice ratio is purely meant for calculation of, accounting treatment of goodwill. So here we have taken only the old ratio, right? Now let us see these items once again. In the left hand side you can see the items A, B, C, D, E, F, reserve fund, employees provident fund, contingency reserve, investment fluctuation fund, employees compensation reserve, profit and loss account, debit or credit balance, like that it is given. In the right hand side you can see a normal partners capital accounts in columnar form. A, B, C, all the three partners are there with some common items. Most of the items I have written for your easy reference. Now let us start the items one by one. First item is reserve fund. Dear students, before we see the accounting treatment of reserve fund, we should know what is this reserve fund. This reserve fund is the funds created out of undistributed profits by the old partners or the existing partners. So it is purely their money. So they have an entitlement, only they have an entitlement or claim on these funds. So if reserve fund is given in the balance sheet, it is a common item. It will be there in most of the balance sheet in the liability side. It may be reserve fund or general reserve, like that. So if this item is given, in this case I have given 6,000 as the example reserve fund. So if this item is there in the balance sheet, it is very simple. Accounting treatment is very simple. It is all partners' money. It is their share of profit. So we have to divide among this 6,000. We have to distribute between A and B in the old ratio. So when we distribute, we will get how much? 4,000, 2,000. So that amount you give to B, give to A, to these partners. Both the partners you have to give, right? So this amount 4,000 and 2,000 will go respectively to A and B's column in their capital account, right? So when you put, so you write it in this way: by reserve fund 4,000, 2,000 respectively. So their capital accordingly will increase. Okay, so that is the first item. Now the second item is employees provident fund. This is another item which will be there in most of the balance sheet. And what is this employees provident fund? This is a fund created purely for the benefit of the employees, for the staff. When they retire, when they leave the organization, they will be getting this EPF. It is for their benefit. It is a staff or employees money. Only they have an entitlement. Partners will not be getting any share of this EPF. So this item also, it will be coming in the liability side. It's a fund liability. It will be there in the balance sheet liability side. So here in this case we have 12,000 given as an example. So this 12,000, it will not go to partners capital account, dear students, because they have no claim on this EPF. So this will go to the balance sheet. You can see it here. I have given. It will go to the balance sheet. I have simply written the balance sheet. No format is drawn there. So it will go to the liability side of the new balance sheet as employees provident funds without changing the amount. The amount will remain as it is. Right? That is the second one. So employees provident fund treatment is like that. Now the third one is contingency reserve. This is another reserve or fund created by the existing partners or the old partners for some unforeseen emergencies. Future is unpredictable, so any emergency may come up. So in order to meet that emergency or contingency, they may be creating a reserve, a fund. As an example here in this case, 3000 is the reserve. So this is also created by the old partners, so it is their money, so it will go to their capital account. It should go to their capital account again in old ratio. So this also has to be distributed between the old partners in the old ratio, and this also will be coming here. You can see this contingency reserve here. A will get 2000, B will get 1000, right? So this also will increase the capital balance. That is the treatment of contingency reserve. So both these reserve fund and the contingency, you can see both are reserve. So it is old partners money. So you simply give to them in old ratio, right? Next one is investment fluctuation fund. The investment fluctuation fund, it is also given in the balance sheet liability side, and there can be different situations, dear students. Now see very carefully. Suppose here I have given a simple example, the investment in the balance sheet in the question, I mean in the question balance sheet investment is given, let us say book value 60,000. Of course investment is an asset, fixed asset, so it will come in the asset side only. So book value is given 60,000, market value is given 49,000. This investment it is subject to market fluctuation. So the value of this investment, it may go up, it may come down. So in this particular case, this 60,000 it has become, you can see it has become 49,000. Okay, that means it has been reduced by how much amount? 11,000 rupees. Of course it is a loss, because asset value decreased means it is a loss. So in order to cover this loss, the partners may create a fund well in advance, right? So that fund is known as investment fluctuation fund. This is a fund created in order to cover the loss arising due to the fluctuation of the investment market value. Okay, so here what is the loss? It is, you can see 60,000 minus 49,000, it is 11,000. 11,000 is the loss. So for that already 14,000 is there in the balance sheet. This is the figure given in the balance sheet, dear students, 14,000. So already 14,000 is there. Now 11,000 is the loss. So you find out the difference. What is the difference? So this 11,000 loss can be easily covered by this IFF, investment fluctuation fund. Okay, still there is 3,000 surplus or 3,000 balance is there rather. So this 3,000 balance, so I have written here 11,000, so balance in fund 3,000. This 3,000 again it has to be again, it will be distributed between A and B in the old ratio. And dear students, this also will come to the credit side. You can see in the investment fluctuation fund here and here, दोनों को मिल जाएगा. Okay, so both partners will be getting how much? 3,000 is the surplus, so they will be getting 2,000 and 1,000 respectively. It's very simple. Okay, so in case the fund is 14,000 and the loss is also 14,000, so nothing remains, so they will not be getting anything. Partners will not be getting anything. The total fund will be covered or it will be adjusted. Suppose if the loss is more, another situation, three situations can be there. It can be less, it can be par, same, or it can be more. If the loss is more, let us say loss is more, let us assume it is 17,000 is the loss. So 3,000 more, because we have fund only 14,000. So this extra amount that will be treated as increase of liability. It is a type of a loss. It is a type of loss. So this will go to revaluation account in the debit side, dear students. So these are the three situations related to investment fluctuation funds, dear students. Right? So it has to be treated accordingly, and journal entry also has to be given accordingly. Now we go to number E. This is also similar to reserve fund. The treatment will be similar to reserve fund, employees compensation reserve. Suppose if the employees have some claim on any compensation due to some accident or leaving the job or etc etc. So they may claim some compensation. So if the compensation is to be given, then the partners have to give. So for this, for giving this compensation, the partners may keep a fund, keep a reserve well in advance. Okay, so if there is no employees compensation is coming up in the previous year, or as of the balance sheet preparation date, if there is no employees compensation given in the adjustment, so this full amount 1500 can be given to again to the old partners through old ratio. You can see it here. Okay, you can see this employees compensation reserve given here. Like if it is 1500 and there is no employees compensation given in the question, related adjustment given in the question, so it will be going to this A and B in the old ratio. Okay, so how it will be coming? It will be coming as 1500. Total money is 1500. It depends on how much compensation is there. If nothing is there, give the full amount. If something is there, you just adjust how much is to be created, and the balance you transfer. So whatever adjustment you need to do about this resource or fund or anything, you do the adjustment. If anything remains, you give to the older partners. If there is shortage, take it to revaluation account. It is very simple. I hope you understood this particular adjustments. That is E. Now the last one, F. Dear students, this is profit and loss account, debit or credit balance. That means it is type of an accumulated profits which is not distributed. It is there in the balance sheet. It may be there in the liability side. It may be there in the asset side also. If it is there in the liability side, it is profit. If it is there in the asset side, it is a loss which is considered as a fictitious asset. Right? So if it is loss, this 6000 should be appear here. You can see I have written it, profit and loss account, debit balance, loss. So you put it here. So how it will be divided? You divide it. You divide it accordingly in the old ratio. 4000, 2000 will be coming. It will be coming in the A's column and the B's column accordingly. Okay. A will have 4000, B will have 2000. This is loss. So by that much amount, the account, capital account will be reduced. So I'm talking about a debit balance. If it is credit balance, it is just, you treat it just like, you can see any profit you treat, you put it in the credit side. See, you can see this credit. If it is credit, see, it will be coming here. Dekha? It will go to A's and B's columns respectively. Okay, you can see it is coming, you can see it is coming respectively. Okay, so dear students, you can see that, see, if it is, see, profit and loss account, if it is credit balance, it will be coming there. Where in the credit side? If it is debit balance, it will be coming here. So both will not be there, only one item will be there most probably. So if it is coming in the credit side, the debit side item will not be there. If it is a loss, then credit side item will not be there, right? Then another important thing, if in any of the cases fixed capital methods are followed, so we have to naturally prepare the current accounts, and so all these items will be going to their current accounts only. When we prepare the journal entry also, we have to give the journal entry accordingly. It should be going to partners current account. So depending on the type of capitals, The method of capital, like a fluctuating capital or fixed capital, the entry will change. If it is fluctuating, it will go to the capital account. If it is fixed, it will go to current accounts of partners. So that will be the minor change. Uh, I hope you have understood this accounting treatment of all these important items in a specific question. With this, we come to a conclusion of today's class, and for the next class, we will discuss another important topic. Right?